It's come in at 0 actually, so unchanged from last month. Now this is a fairly significant development. If it comes at zilch, then actually the month-on-month fall becomes very big. That means we are getting a index number reading of 181.5, which is a big fall from the 183.9, almost 184 in the previous month. So that is a 2.5 almost point fall, which is a 1.25 percentage or 1.5% fall month on month. So that's a fairly big fall we are seeing in the numbers. We are still waiting for more details. All we have is the overall number at this juncture, and predictably the PIB website will never work well at the nick of the time. But this is a big fall. 1.1 itself would have meant that there is a marginal increase month on month from the numbers, or there would have been a marginal decrease month on month as well. Last month's index was 183.9. If we had done 1.1, we would have been at 183.4 or thereabouts. But now we have come down at 181.5. So that's a fairly significant fall. Okay, now we have all the detailed numbers. The food inflation year on year is down to 0.63%. And month on month, the food inflation has fallen by 0.39%. The overall primary articles inflation, okay, all commodities index has fallen month on month by 1.3%, and the overall index, like I told you, would be 181.5. Primary articles are down by 1% month on month, and almost 1% also year on year. Food articles, like I told you, is a fall of 0.39% month on month, and the rise year on year is down to 0.63. The biggest contributors would be vegetables, which have fallen 28.5% year on year. That's not surprising. Please remember, November of 2013 was the time when onions sold at 70 rupees and cauliflower sold at probably 80 rupees. You know, that was the big inflation month. CPI at that time was running at 11.2. So there is a 30% almost fall in vegetable prices year on year, and month on month as well. From an already low October base, it's a 1.5% fall in vegetables. What has risen is only onions month on month. Otherwise, even fruit and other food related elements have also fallen. Among cereals, it's only pulses that are marginally higher month on month, and year on year up by about 4.4. More important, it's manufacturing products. Manufacturing products are down 0.26%, the index itself, month on month. Year on year, the manufactured products index has fallen to a rise of just 2%. It is still rising, but it is 2%. I think your averages were giving you 2.45 or thereabouts. It's fallen, the rise has been slower than what analysts forecast at 2.04%. And if I'm not mistaken, last month it was about 2.5%. The rise in manufactured products in November is 2.04. Yeah, last month it was 2.45. So there is a slower increase in manufactured products as well. Within manufactured products, cotton and man-made textiles have fallen. And therefore, my estimate is that the core inflation would have fallen even below last time's level, because the manufactured food items have actually been lower. Also lower month on month are chemicals and chemical products, and that is very important. This is clearly a crude derivative impact. This is the clear pass-through of global prices, and chemicals has a huge weight. I think this singly will reduce the manufacturing index because it has a 12% weight in the index. So if chemicals fall by 1/3% month on month, that is enough to remove all inflationary impact from the manufactured products index. So manufactured products index has fallen 0.25% month on month. Year on year has risen by just 2%. The other big elements that have fallen is also basic metals and alloys. That is down 0.5% month on month. That has a 11% weight, 10.74% weight in the index. So that and chemicals by themselves month on month would have reduced manufacturing products to near deflationary status or disinflationary status. And that explains why you have a manufactured products index going by just 2%. Well, I assume I've covered most of the main things. Jahangir, first thoughts?
No, this is a big move in terms of core inflation. If those numbers that you were telling me were right, I think core inflation going down will be a big thing. But again, you know, going back to the point that you were raising about monetary policy, I think does RBI think that because of these numbers, because of these flow of numbers, what does that do to its 2016 inflation and beyond? And that is where I think the critical judgment needs to be made. And I think the critical judgment will be based on what is the pace of activity, both global and domestic, rather than simply that of inflation. Because at the end of the day, we and the RBI and everybody else will have to make a judgment call where the decline in commodity prices that we are seeing, whether this is a reflection of greater supply in oil, or is it a reflection of surprisingly low demand that might come through in 2015.
Okay. Aditi, your thoughts on the WPI inflation number, 1.1, 0% this time round versus estimates of 1.1%?
You know, this is even lower than my estimate of 0.8%, which I thought was, a fair bit below the consensus. Clearly, both core inflation and food inflation are lower than what we had penciled in. And I think particularly in terms of the current policy framework that we have, what's most important in terms of the interlinkages between the WPI and the CPI is really going to be food inflation, because that's where the pass-through is going to be quickest, and we're going to see, with a little bit of a lag, movement from the WPI to the CPI. So as far as the predictive benefit that we get out of the WPI, I think the focus is a little bit more on what's happening with the food pack. And here, at least whatever I heard from you does seem to mirror a lot what we saw in the CPI as well, that, pulses have gone up month on month. And I think that really, at least for the next few months, remains the key thing to watch out for, or the key risk as far as food products is concerned. Beyond that, I think our estimate is that from next month onwards, we are going to see food inflation on the WPI rearing back up to a fairly elevated number. And I think that is something that we need to be watchful about. As this base effect goes away, how does the rest of the food inflation behave for the rest of this calendar year? And I suspect that it's going to be a little disconcerting. Core inflation certainly coming down is positive, but that mostly reflects global supply and demand conditions rather than being a very key reflection of what's going on with domestic demand conditions. So I think although that is a positive in terms of bringing the WPI down, the transmission of commodity prices into the CPI is fairly slow, and as we've seen in the last couple of months, the MOM increases in the CPI for the non-food basket has been fairly substantial. And particularly in terms of the RBI framework, we still think that CPI is going to be back in the range of 6 plus minus 0.2% by March. So very much in line with the January 2016 target of 6%. So possibly not really a case for an earlier rate cut.
Okay, so both economists, both guests maintaining that despite WPI coming in seriously lower than what was anticipated, 1.1 was anticipated, it's come in unchanged from year-ago levels. This must be something of a record. I think since the great financial crisis, global financial crisis, which is, I think, the first 6-8 months of after September 2008, we have not had such WPI inflation numbers, for that matter even CPI, though that's a newer index. So both of them, in spite of it, not expecting that there is any data support for the Reserve Bank to move earlier. Well, actually, I think the bulk of the bond markets are also believing that, because after trading at 7.78 earlier today, the bond yields have gone back to 7.8. At the moment, on the verge of 7.8, moved down 0.0003% lower at 7.7971. Ashok, Gautam, what's your own sense? What is the market pricing in now after listening to the inflation numbers, you think?
I think market was still very clear that the way Reserve Bank of India governor has mentioned that they would like to see the data going forward, because this particular month number was certainly, as everybody else has been saying, largely the numbers which are coming are due to the higher base effect. So certainly market had already priced that in, and probably the next large move would start coming in post this month and early into the next month. But we still believe that what the WPI numbers which have just now come and are indicating that we would certainly see a little bit of a comfort on the CPI numbers also, and probably from the market's point of view, we still believe that within this financial year we could see a quarter basis point, 25 basis point rate cut certainly till March. And bond market certainly has priced that in, and going forward we believe that maybe our range of 8.65 to 8.95 is something, 7.65 to 7.95 is the range where certainly the 10-year yield would set in for some time.
Okay. Jahangir, I just wanted to ask you about your expectations on the CPI data for December. That's when possibly, the base effect is expected to wear off as compared to the previous months that we've seen. Your sense?
So we have the similar thing Aditi has, that we do expect CPI inflation to move back up at the end of the base effect. Probably closer to 6% by February. But the crucial thing that has sort of, sent things awry has been the fact that core inflation in CPI has already jumped on an annualized basis from the last 2 months to 8.5%, something that we hadn't thought that the increase would be that big. In addition to that, if you look at PMI data of the last couple of months, even though we have actually seen output prices picking up. In other words, corporates aren't willing to pass on the decline in input prices onto consumers. So given all of that, it seems, that 6% could move to about slightly higher. But beyond that, I think it will be very difficult unless, oil goes back to where it used to be before.
Okay, well, Jahangir, actually, that is not the kind of data we are getting at this point in time, isn't it? There is a debilitating fall in the purchasing power of, say, Russia, of the entire OPEC group, of Venezuela, Nigeria, of a whole host of countries. Not that they added up a great deal to global demand, but certainly Brazil and Russia would. China's PBOC economic advisor today says that he expects Chinese economic growth to slow down even further. This is unrelated to the commodity price fall. In fact, like India, China is a beneficiary of commodity price fall. And yet that big engine of commodity consumption is telling you that they're going to incrementally consume less. So, is there not enough raw material in the global sphere for core inflation and manufactured inflation to fall similarly more? Look at the month-on-month fall in chemicals and semis and basic metals. They alone have contributed to a disinflation in the manufactured space. So will not that trend only exacerbate, at least for the next 3-4 months? You can be very sure that these great land masses, Russia, China, Brazil, are not going to pick up anytime soon.
No, we have already seen manufacturing disinflation in the world. If you look at China, for example, for 2.5 years, Chinese manufacturing producer prices, their equivalent of core WPI, has been deflating, not even disinflating. If you look at European or the US core inflation numbers, these haven't really picked up very much, largely because there's a massive amount of excess capacity globally in the manufacturing sector. But the question that you're asking is somewhat different. So should I look at the decline in commodity prices and oil and presume from there that global growth is going to be lower, or should I take this as a sign that supply, the Libya and the new production facilities in North America, that is the one that's creating it, and the increased energy efficiency of US and Europe, those are the ones responsible for the decline.
No. My question is, no, sir, Jahangir, my question is that since there will be this major disinflationary, deflationary impact on a large part of the CPI, do you think there is any danger of CPI really going up? We may not have. Maybe we have not entirely won the battle on food, as Aditi was pointing out. She's worried about pulses. I would worry about milk also. That's up 10% year on year, and global milk inflation has not subsided. Likewise, the Rabi sown area is lesser than what it was last year. So, in spite of what we may see some negativity in food, is it made up by non-food?
Absolutely. But how does that change the landscape, change the context
Does it
within
change?
which RBI is operating? If the RBI is operating in the context that what really matters is what they expect to happen in January 2016 onwards, for them to decide whether or not to do a rate cut now, then, whether the inflation falls in the first quarter of next year doesn't really move very much. What can we say about inflation, global, including India's inflation, in the first quarter of 2016? That's the key question. I'm not saying that there won't be rate cuts. In fact, we have a rate cut, and as we were talking about this last time, we actually have a 50 basis points rate cut, not even a 25 basis point rate cut happening either in March or in April. So that's not the point. My point is that in order for Reserve Bank of India to say that, look, I'm perfectly happy to lower interest rates by 50 basis points or 25, whatever the numbers are, they have to be able to say that from 2016 onwards, India's inflation will be comfortably below 6%. What is comfortably below 6%? Let's take a number, 5.5%. So
Okay.
Can you say that inflation in 2016 is going to be 5.5%? You can't.
Yeah, fair enough.
Okay, well, Aditi, I wanted to come to you with regards to what you think the RBI is possibly going to do come Feb with the amount of data that we've got. We'll get 2 more inflation readings by then, but considering that the IIP data was a little mixed, what do you think the RBI's thought process would be on these 3 data points at this point? Not their thought process, but their sense.
See, as far as the IIP data for October is concerned, I mean, clearly I think we should wait for another month and really look at the average for October, November. Typically, we do that every year in any case because, even a small shift can have an impact on what factory output looks like. I mean, even 1 or 2 days here and there as far as factory shutdowns are concerned can have an impact on factory output, and we are not adjusting for the number of working days when we get the data from CSO. So, I would urge just to wait for a month before, getting too alarmed with the IIP data from October. Going ahead, broadly the sense we're getting is that there would be cuts of 50 basis points. I don't think the first cut is going to come before the budget is presented. Given the recent commentary, I think the RBI would want to see what the revised estimates for this year look like, and maybe a little bit what the budget for next year looks like. And then we could expect about 50 basis points cut, either in 2 cuts between March and April, or maybe March and June. So after that, again, we're expecting an extended pause.
That's also your take, isn't it, Jahangir? Either March or April. March or April is when you're expecting the 50 basis?
Yeah, it's either March or April, but it's a one-time cut of 50 basis rather than 25. Again, this is part of thinking in terms of inflation targeting framework.
Okay.
In inflation targeting framework, you always want to be ahead of the curve.
Fair enough.
25 doesn't make you ahead of the curve. So.
Okay, doesn't make you ahead? I don't know. Well, let's get let's get Ashok Gautam as well on this. Ashok, you said 795. Why would the yield go to 795? And at what point does it go? And where do you see it, say, beginning March, which is when our economists are expecting the first cut?
Yeah, so okay, what we are saying that this is a range which we are trying to look at, and fair question that why we are saying there is a possibility of going back to 795. That all depends, what kind of data we see next time coming in, when the base effect actually tapers off. Because at this point of time, market seems to have priced that going forward RBI would be comfortable in cutting by, say, at least 25 basis point in the next quarter of this, the last quarter of this financial year. But certainly if the numbers which are going to come and they point that there could be a delay or there could be a rethink, then probably the market could go back up to 7.95. That's why that range which we are giving.
Okay. But since they are expecting even a 0.5% cut, would you think that by March yields could go towards 7.5, even below 7.65 that you're talking about?
Yeah, certainly. 7.65 then certainly is given, but then obviously the move would be towards 7.50. if 50 basis is something which is going to come. But we believe that probably 25 basis point is something which seems to be a more probable case from the market participants' point of view.
Okay. Aditi, are you going to change your inflation trajectory at all post these numbers?
So for the WPI, we were expecting, the headline to come back up to maybe levels of 2% by March of 2015. Perhaps we could see a little bit under that. I mean, I expected the WPI to come in today at 0.8 and it's come in flat. So maybe somewhere between 1.2 to 1.5% as far as the WPI is concerned by March.
Okay, well, final question to you, Jahangir. Do you think the RBI governor can withstand political and media noise after 0% inflation? It's going to be a bit difficult, isn't it?
Look, I mean, he's done well so far to avert the pressures. I mean, clearly the pressure has been very, very strong. But if the way in which he has sort of communicated with the public and the government and the market is that I really need to see myself looking at 2016 onwards to see whether or not I can cut rates. And I think that language has been important in trying to buffer these kinds of pressures. And I think that has been a very well orchestrated communication by the RBI, that it isn't any longer what happens in the past. It is what does the past imply for the future. And, as I said, I mean, very few of us can, claim that 2016 inflation is going to be 5.5.
Yep.
Given whatever your growth numbers are for 2015 and 16. That's a very difficult call.
Fair point. We'll have to leave it at that. Out of time. Jahangir, Aditi, Ashok Gautam, thank you very much for joining us with your views.